It's the term that sounded alarm bells for the 2008 global financial disaster. And suddenly, it's back.
There's going to be a credit crunch.
Is there a credit shock, a credit crunch around the corner?
A credit crunch is coming.
Some say banks tightening their lending conditions while collectively writing off more than $3 billion in loans customers couldn't repay are the hallmarks of a new credit crunch. Inflation and high interest rates for mortgages and credit cards are all increasing the squeeze, even if the US central bank insists fundamentally all is well.
Our banking system is sound and resilient with strong capital and liquidity.
And yet the comparison is easy to draw between the 2007 credit crunch and the global financial crash a year later. Loan defaults were at the heart of it.
The picture today is arguably more nuanced than that. Some of the biggest US banks, including Bank of America, have just reported impressive first quarter results, despite persistent high inflation and concerns that a recession is looming.
Indeed, Bank of America profited from higher interest rates, though these rates contributed to Silicon Valley Bank's bankruptcy last month, one of 3 regional US banks to collapse. So consumer sentiment is as mixed as the banking picture.
Everything is getting expensive, starting with the eggs, it's crazy.
Groceries are sky high.
As long as my banks and finances appear secure and there's no risk of a bank run, I'm not concerned.
Nevertheless, big banks weathered the tremors their smaller compatriots sent through the financial system because they're considered stronger than they were back in 2007. And JP Morgan Chase chief executive Jamie Dimon thinks resurrecting the term credit crunch is an exaggeration, even if he and his rivals have been ramping up their reserves to cover those loan write-offs. Owen Fairclough, CGTN, Maryland.